We love having you on because of the historical context you can put today's investment advice. But, I mean, we look at what's happening in the market. When you're thinking of a juggernaut of $100 billion coming into US AI and energy, well, it feels like a lot of money's already gone that direction.
Yeah, well, when you rebase it relative to sales or relative to market cap, I mean, you haven't really seen that much of a move. I think we talk about this all the time with money funds sitting on the sidelines, how much cash is on the sidelines, or how much cash in terms of nominal capex. But when you actually renormalize it, given the move that we've seen in the marketplace over the last, 5 years, it's a much lower percentage than you would think. Interestingly enough, specifically for tech stocks, and I would say more specifically for software stocks, capex is very much an alpha factor, meaning that spending is usually a good thing for stocks because it's very correlated to earnings growth.
Okay, so I'm not going to ask you as to opine as to where exactly Masayoshi Son's going to be putting his investment, but if you're looking at an everyday, whether it's retail or institutional investor right now allocating to opportunities, do you have to be put off by some of the valuations right now, or actually do you keep chasing the momentum, keep chasing the names that have done well?
Well, it's interesting. So technology has had a little bit of underperformance over the course of the last 6 months. And because earnings growth and free cash flow has been so strong, you're actually out of anomalous valuation situation. So I define anomalous valuation as top quartile. So we have fallen out of top quartile levels, which is where you see the risk reward become fairly negative for tech. Now, as we enter 2025, coming out of that top quartile valuation zone, I actually think it sets up for a pretty positive risk reward. And for all the talk about momentum stocks, on our data, when you look at it specifically within technology, I'm not seeing any anomalous behavior, meaning I'm not seeing top quartile relative performance over the last year, and I'm not seeing top quartile valuation on that top quartile of momentum, meaning that because earnings and free cash flow are so strong, there's no valuation situation where you're saying you're overpaying on a consistent basis for technology stocks that have been leaders in the S&P 500.
Wow. So it still feels like there's basically opportunities in the Mag 7. What about the next tier down? We started to see software names really come to the rise as people started to reallocate perhaps from the semiconductor trade out to the killer applications being born out. Is that something that you'd like to see more of?
No, that's a great question and a great point, because of the three big areas within technology, if you say hardware, software, or semis, where are the opportunities, it looks very interesting on the data in software to me. Given the strength in free cash flow and earnings valuations, you're actually in the bottom half of the distribution from a valuation perspective when you look at all the data back to 1962. Wow. And what you see is that very much empirically skews your risk rewards odds for the software sector specifically. So when you have strong growth and valuation support, it's a very positive risk reward for the sector. Of those three, hardware, software, and semis, software is the only one of those three industries that looks like that. So I think as we enter 2025, that's where it looks like the opportunities are to me.
And in the US, Denise?
Yes, in the US.
What of the US exceptionalism and this trade that we all keep talking about? I mean, is it going to dominate for 2025?
To me, it does look like that. So everything outside the U.S., whether you want to talk about IFA, EM, or ACWI, ex the U.S., what you find is that valuation screen looks like a quantitative value trap to me, meaning that when you bought in that bottom quartile relative valuation on earnings or free cash flow, you only have 30% odds of outperformance. Like 30% is not zero, but at the same time, it's hard to say that that valuation is a critical driver. And the reason why it's not a driver is because often international stocks are cheap for a reason. Even on a sector neutral basis, taking out technology, median stock to median stock, the S&P 500 outgrows their international peers by about 300 to 400 basis points a year on earnings, and it's growing every cycle. So unless you think something is going to change that hasn't been the case over the last 15 years, I think the risk reward is still more favorable in the US.
This is why your historical context is so important. Denise, I go therefore to the macro picture. We are, of course, seeing the micro news on an investment coming from Massa, but we're also seeing the macro news of we're waiting on rates to go down. What does that mean for that cash on the sidelines that still perhaps is waiting to enter?
Yeah, so rates, let's talk about rates being an alpha factor for the market. I think people get a little confused in terms of thinking about whether or not the playbook is a good thing or a bad thing. Rates are not the critical driver. Earnings growth is the critical driver. So when you look at the Fed from a playbook perspective, sometimes the Fed's cutting because they have to. That's not good for the market. Sometimes the Fed's cutting because they can. And what you see from a quantitative differential from those like trying to divide those two is your starting point on earnings growth matters a lot. Our starting point of positive earnings growth usually predicts a more bullish situation for the S&P 500. Your starting level of the Federal Reserve matters a lot as well, because that's essentially a mathematical definition of the Fed put, meaning if the Fed is high relative to inflation, they can do something to the extent that the economy is hit with a shock. That's a good thing. That's our situation as we enter 2024. And most importantly, the Fed can definitively change willingness to lend of banks. Because that's been in contractionary territory and because that's likely improving, earnings growth is likely to broaden out in 2025, include those small businesses have been lagging, and that skews your risk reward being pretty positive as we enter 2025.
But then how risk hungry do the edges of the market become? I mean, we look at a day where MicroStrategy, which has basically been a leveraged bet on Bitcoin, hugely outperformed Bitcoin in and of itself, is now going to be added to the NASDAQ. I mean, are we going to see more money flow to those sorts of riskier edges?
No, that's a great question. So, I mean, without talking about the idiosyncratic names, when I look at quality, which is sort of the opposite of the factor that you're talking about, it's been a darling of a factor, much like low vol was, only underperforming, I think, 3 in the last 20 years. Well, that's left quality stocks fairly expensive. And that doesn't necessarily mean those high quality stocks need to underperform by a lot, but to the extent relative earnings or those relative returns start to inflect lower, that usually does lead to underperformance in the factor. So for anybody with a quality bias, I'd think about scrubbing your portfolio and thinking about better risk rewards in what have been historically riskier names.